Welcome back, Focus Learners, to another explainer. Today, we're tearing into something fascinating, a 64-page SEC Form 10Q filing from a literal American icon, Levi Strauss Co., and this covers their second quarter of 2026. Now, I know financial filings can feel like staring at a brick wall of accounting jargon and endless tables, but honestly, that's exactly why we're doing this. Instead of getting lost in the weeds, we're going to unpack this raw data together. By the time we're done, you're going to see exactly how a century-old brand maneuvers through today's wild global markets.
So here's our roadmap for today. 1. The Q2 2026 scorecard. 2. Saying goodbye to Dockers. 3. Inside the balance sheet. 4. Rewarding the shareholders. And 5. Hedging against global risks. Let's get right into it.
Chapter 1. The Q2 2026 scorecard. Top line wins. Okay, so when you crack open any earnings report, you want the bottom line up front, right? What's the overall temperature of the business? Well, how about $1.56 billion? I really want to anchor us to the sheer scale of Levi's success right out of the gate here. For just a 3-month period ending May 31st, 2026, Levi's pulled in a massive net revenue of $1.56 billion. When we talk about global reach and raw brand power, this is literally what it looks like.
And this wasn't just a strong quarter in a vacuum. It's a really clear jump from the $1.44 billion they reported in the exact same quarter last year. So we're seeing meaningful top-line growth year over year, which, as we know, is basically the foundational signal of a healthy retail operation. And what really grounds us in reality here is the actual cover page of the Form 10Q, which was filed with the SEC on July 8, 2026. I love looking at these because they aren't abstract marketing numbers or, polished PR spin. This is a sworn financial reality. It's legally binding, it's audited, it is the absolute ground truth of the company's performance.
So if we peel back the onion on their consolidated statements of income, that $1.56 billion in revenue, it gets reduced by the cost of goods sold, which came in at $582.9 million. Then you take out the selling, general, and administrative expenses. By the time you get all the way down to the bottom line, Levi's posted a really solid net income of $87.3 million for the quarter.
Chapter 2. Saying Goodbye to Dockers, the Strategic Pivot.
Now, revenue only tells half the story, right? To really grasp a company's future, you got to look at what they're leaving behind. The crucial point here is the massive contrast between their continuing operations and their discontinued operations. Levi's made a highly calculated decision to focus entirely on their core high-growth engines. That's the main Levi's brand and Beyond Yoga. To pull that off, they had to shed some serious legacy weight, meaning the entire Dockers brand was shifted to discontinued operations. They completely severed it from their future roadmap.
Let's translate a little bit of that SEC jargon into plain English for a second. When you see discontinued operations in a filing like this, it formally means the assets and liabilities of a business have been separated into a disposal group to be held for sale. In incredibly simple terms, Levi's formally boxed up Dockers, separated its accounting from the main business, and basically jammed a for sale sign on the front lawn. And this timeline shows exactly how that offloading actually played out in the real world. Back in July 2025, they sold the US and Canada Dockers operations for $194.7 million. Then, moving into early 2026, they started multiple closings for the remaining global operations, and they ultimately finished that final closing in February 2026 for an additional $96.3 million. By breaking it apart like this, they successfully turned a legacy brand into hundreds of millions of dollars in fresh capital. However, even after a sale is finalized, the accounting isn't instantly clean. Actually, the Q2 2026 income statement still shows a $7.5 million net loss from discontinued operations. Why? Well, because winding down massive global operations takes time. That $7.5 million just represents those final trailing costs, the administrative and legal loose ends of saying a permanent goodbye to Dockers. Chapter 3. Inside the Balance Sheet, the Corporate War Chest.
All right, so now that they've shed that weight and secured all that capital, let's shift our focus from the income statement over to the balance sheet. Looking at this consolidated sheet gives us a perfect snapshot of the company's financial health as of May 31st, 2026. Because remember, an income statement tells you how a company performed over a specific time, but a balance sheet tells you what they actually own and owe on a specific day. It is the ultimate measure of liquidity.
And the big takeaway here is that Levi's is operating from a position of absolute power. I mean, just look at these numbers.
They are sitting on $849.3 million in pure cash and cash equivalents, plus another $128.5 million in short-term investments. Guys, that's nearly $1 billion of highly liquid capital. Throw in a massive $1.15 billion in inventory ready to be sold, they have built an incredibly robust financial fortress.
Chapter 4. Rewarding the shareholders, putting capital to work.
So when a company is sitting on a massive war chest like that, the first thing investors ask is, okay, what are you going to do with it to reward the people who own the stock? Well, the 10Q gives us the exact answer. Levi's announced a massive $200 million accelerated share repurchase, or ASR program. When a company buys back its own stock, it reduces the total number of shares available out there on the open market, and that means every remaining share instantly represents a larger slice of the company's profit pie, obviously boosting value for the remaining shareholders.
Here's exactly how an accelerated share repurchase works in practice. Step 1. In January 2026, Levi's handed over $200 million in cash to a financial institution. Step 2. They immediately received and then permanently retired 7.8 million shares of stock right then and there. Step 3. The final math, which is based on the volume-weighted average price of the stock over time, will be settled in Q3 of 2026. It's a highly aggressive, highly confident way to deploy capital.
Chapter 5. Hedging against global risks. Future-proofing.
Okay, we've seen their revenue, we've seen the strategic pivot, and we've seen the cash. But how does a giant international retailer protect all of this wealth in such a volatile world? Because there's a huge hidden risk to global business. When you sell jeans all over the world, you're dealing in euros, yen, pounds, and dozens of other currencies. If exchange rates suddenly shift, it can literally wipe out your profits overnight. To protect against this, Levi's uses what are called forward foreign exchange contracts. In super simple terms, these are specialized contracts that allow them to lock in an exchange rate ahead of time. They are essentially buying insurance against unpredictable global markets. This cleanly presents the staggering scale of these hedges. Check out the total values as of May 31st, 2026. They've got contracts to buy $754 million in foreign currencies and contracts to sell $894.5 million. We are talking about deploying hundreds of millions of dollars into derivative instruments for the sole purpose of stabilizing your global cash flow through May 2027. It's this massive, unseen balancing act that just takes the business running smoothly, regardless of whatever geopolitical or economic turbulence is happening out there.
Which leaves us with a pretty fascinating final thought. When you step back and look at this 10Q as a whole, you aren't just seeing math. You're looking at the survival mechanisms of a century-old brand. So, is having the discipline to shed a legacy brand like Dockers, combined with the extreme financial sophistication to aggressively hedge global capital, is that the ultimate secret to surviving a century in retail? It's honestly a strategic masterclass hiding right in plain sight within 64 pages of SEC filings. Thank you for joining me on this explainer. Focused learners, keep asking questions, keep looking at the data, and I'll catch you next time.